All right, folks, good evening. Let's go ahead and get airborne with our, oh my God, I did get some sun today. Holy crap. Running on the beach here, folks. Let's get airborne with our vertical spread training tonight. You're going to meet our vol arbitrator, Doug Robertson. Folks, the slots are open. I didn't update this like in the past hour, so I think my phone is buzzed. I think there's been some calls to support. I think we have about 40-ish left. So I know exactly the lobster. It's kind of embarrassing. I did wear sunscreen, guys. Trust me. I like running on the beach actually during the hottest time of the day because I'm an idiot, and then I enjoy the sweat. Okay, we have a lot to cover tonight, folks. Here's what we've done so far. We did the welcome aboard 8 o'clock. We did the PLTB at 10 a.m. yesterday. We did our AR this afternoon. We had a blast. A lot going on during the AR. I'm going to cover some Apple stuff tonight before I introduce Doug because we have to cover that really cool tactic called a bullish double vertical on VXX. So hopefully you guys got to watch the replay. If you didn't, I'll show you where to get that. Tonight, we do vertical spread training. Doug's got a couple nice surprises. And then we're going to do the demo do that we do here at Top Gun Options. A lot of do's in that sentence. So tomorrow morning, Doug's going to practice what he taught you tonight live in the advanced live trade brief at 9 a.m. Sometime tomorrow, he'll get out an advanced trade alert, and then he and I will knock out a debrief Friday afternoon at 1 o'clock for about 30 minutes. Any questions about any of the trades from the week, and then I'll close out our full throttle week with our weekly options live trade brief. Let me get a show of hands. I know a lot of our members come to these, even though these are for potential new members. How many of you closed the SPX bear call spread that I sent out on Monday? Because I sent out the text alert to close it at the end of the accelerated retirement live trade brief. And then what happened to the market? It actually recovered, and I think the S&P closed a little positive. So when I sent out that text alert, it was what? It was exactly, Brent, it was at the bottom. It was at 60 cents. So hopefully everybody got out of that and made it nice, I don't know, 50%, maybe $1,000 in about 2.5 days. That's pretty cool. So take that and put that, yeah, look at Brent. Yes, Craig, out, fish. Great call. Thanks, guys. Okay, so for those of you sitting here, well, that's great. Well, folks, we do the weekly options for you guys on Friday. I do it for my normal members earlier. Okay, so do me a favor. We can't hold when you call and say, hey, please hold me a spot, or you email support. It's got to be first come, first serve, folks. So no offense for folks like, hey, I have to check with my significant other. I get that, but please do it pretty quickly, or I got to move some money around because, like I said, 50 is our magic number, and then we close it down. We had a perfect example of why today because it was a little bit of a zoo, and Doug will see it tomorrow morning. Doug and I are wired the same. Even though he's an Army guy, we'll get into that. As instructors, we don't want to leave a room with any unanswered questions or a clue bird, flapping on your shoulder. We'll stay here until the cows come home. It's so hard with hundreds and thousands of folks. Like I showed you today, we have over nearly 8,000 people registered for this week. It's a zoo. So we can't hold anymore. I'll cover some quick admin items. I want to cover that Apple bull put spread because it did go through the eject level, and you didn't hear from me. That's a very important teachable moment that we're going to cover tonight and actually somebody sent an email to support, Steve, and I won't show your last name, but very good email, and I'm going to share it with everybody because that's the way Doug and I operate here at Top Gun Options. Nameless, rankless, and it's all about improving our execution. I'm going to turn it over to Doug. I'm going to go as fast as I can so I can turn over to Doug because he's the focus of tonight. I'll close, and usually during tonight's live trade brief or Doug's training, people are buying their slots. So I'll keep you updated in the chat box. You guys know me. Let's get rid of all that stuff. We talked about the Tredge. We talked about the SPX bear call spread, the weekly that I'd get out of. Even if you're not out of it yet, I'd get out of it tomorrow because I think this market, if we're shrugging off the end of or the Fed getting rid of their balance sheet, man, you can't keep this market down. So real quick bear call spread in and out. Here's what I want to talk about. There's all our performance. You guys have seen this all week. The year-to-date performance is pretty freaking cool. 63 for an 85% return on risk. AR today is nearly 50 through July audited, 63% return on risk. And then obviously the PLTB pulling up the rear with about a 35% return on risk. So here we go. Before I introduce Doug, everybody read this with me. So Stephen, let me check all the comments here. Stephen, are you in here tonight? because this was a good email to support. Our alert for the Apple trade alert clearly stated eject at 126. Today, you scold new listeners for asking about Apple. They need to give it time. You also drilled us Monday on the importance of ejecting out of a crashing jet discipline. While Apple did break above this morning, and if everyone listened to you, should be out of Apple. You can't have it both ways. Stephen, thank you for this, because that means I did not stress this enough. So actually, let me go to steps 5 and 6, or 6 and 7 of our mid-course guidance. Ladies and gentlemen, as Doug can attest to in the military, everybody look over here. You see this? This is a Navy, that's the Navy F-18 flight manual. It's as thick as a phone book. In the front, I don't think it's right there, folks. I think in the first page of every Navy flight manual, it says this: nothing in this manual takes the place of good head work and judgment of the pilot in command. The pilot in command can deviate from any of these procedures in here. And I forget the rest of the wording, but he or she better have a pretty damn good reason, and it better work out for you. So here's what I should have said if I didn't say it more clearly yesterday, because I did focus on the Canadian guy ejecting. Here's my point. If you don't hear from me, I'm still in the airplane, okay? There are times where I will absolutely fly through the adjust and eject criteria. And here today was a perfect example of it. What was the news on Apple today, guys? It was like a little bit of a glitch or something like that, right? With this watch or something like that. That's a hiccup. So the day after I put a trade on, it's got a hiccup like that. There's a lot of time left to expiration. So Stephen, if yesterday I went out of my way to say, people die if they don't follow procedures, I'm absolutely right. But there are times where you put the cigar in your mouth, you open the canopy with the smoke coming out, and you let your scarf out and go. I'm going to try and save this. And remember, when I typed, I didn't listen to the recording, but guys, every time I know for a fact, 99% of the time when I'm typing in the text alert in the live trade brief, what do I say? I would, and it begins with a P. Where are my members? What word do I throw in before I enter the adjust and the eject levels? Rebecca, you're a quick typer. So what? Potentially. What did I say? I would potentially adjust this trade if it hit X, and I would potentially eject around here. So Steve, if I didn't stress that enough, that's my fault. I take responsibility for that. Here are the times that I will stay with a burning airplane or a burning trade, especially the day after I put it on, folks, is this. Thank you, Judith. Yep, thank you. Probably, potentially, that's what I say. Folks, if your strategic mindset, cautiously bullish, and my commit criteria, remember the 3 to 5 sentences that I put out on Apple yesterday, if those are still valid, I stay with the trade, even if it's through my adjust and eject. So let's take a look at Apple real quick. And I don't want to take up too much of Doug's time. You see this? Let's look at the round trip that Apple made today. And it's kind of a laughing term, I'm going to say. This is what we call premature ejection, okay? So this is one of those times where I'm like, and here's why I didn't want to, Stephen, when people were bringing up Apple in the accelerated retirement brief, when you become a member, Doug and I don't like talking about trades from other portfolios in one of our trade briefs where that trade isn't in that one. First of all, some members are just in accelerated retirement. They don't even know what weekly options are, or in the primary live trade brief yesterday. So if I spend a half an hour talking about Apple, they're sitting there in the accelerated retirement members going, yeah, thanks for eating up our time, guys. So that's why I was going to save it to the end, and then Janet popped on. But Stephen, excellent question. I will state this again. If you do not hear from me, I am still in the trade, okay? I've opened to page 1 of my Navy flight manual and said, I'm the pilot in command of this portfolio, and I'm sticking with it. So Stephen, I don't know if let me see if you're in here. Or Fish, good point. Go to the ready room. I didn't bring that up yet. That's an added benefit. There's an online forum on our site that in between the live trade briefs, you can talk to Doug and I right here. Under member content, you go to Ready Room. So, and I didn't write down the guy's name. One of you is an American Airlines pilot saying, hey, we have a ton of guys from every airline in here. If you're on a layover or in between live trade brief, guys, look in here. EWZ thoughts, looking at a 914 replay link. Where's the AR trade possibilities? All this stuff. Here is the ready room. So Stephen, great point. I did not do a good job yesterday. I think I did. I went overboard on the, hey, you got to, stick to your adjust eject. But I'm pretty damn sure I said, hey, I'd potentially adjust at this price or potentially eject it at that price. I know I do because I'm an options trader, and I would say that. I would hedge that. I would not just blindly eject. Apple, I think, needs another day to see if, holy crap, this watch is going to be the end of Apple, or it's going to hold that level. And it looks like a triple bottom. Does everybody get that? This was an important, Obama teachable moment. I wanted to take 5 to 10 minutes out of Doug's time to cover that again, because to get a very spirited comment like that means I failed and I wanted to clean it up. So are we good? Vertical head nods? If you don't hear from me, I'm still in the trade. If not, if you hear from me, like today, I said, hey, let's close that weekly options trade. We good? Awesome. Thanks, guys. So, Steve, thanks again, man. Hopefully you're in here. Great email. Great point. I'll tighten that up for next time. I will definitely do a better job of, instead of just showing a dude ejecting, showing that Navy flight manual and saying, hey, by the way, though, there are times when a trade, especially today with a little bit of velocity, it slams through the eject level. Whoa, everybody just calm down. I know all my members are typing in one of my favorite words right now is a lucky strike moment. Remember in all these old World War II movies, guy gets shot in the chest, screams for the medic. What's the medic do? He runs up and gives him like a lucky strike, so we call them lucky strike moments. Okay, Fish, they will learn when they join. Thanks, Fish. I appreciate it. Okay, so let me get out of the way here because I want to introduce our 500-pound head here, and his name's Doug Robertson, and not because of the picture, or maybe because of the picture. 500-pound head, guys. He's a brilliant options trader, ones and zeros type of guy, Excel spreadsheets, all sorts of stuff. Doug and I, at the end of the day, we both have the same mission objective, flying our Hornets, to shoot down MiGs. He and I fly and fight the jet a little bit differently. So this is why Doug and I are here at TGO. He teaches the advanced, the full throttle, 8 sessions, the training sessions. Tonight, you're getting a free demonstration of the training that Doug's going to give you. We don't give you education, folks. The world's full of educated derelicts, and most of them are at Berkeley. He's going to train you, and he can talk about the syllabus. He's a vol arb trader, a quant. Back in the day, he worked right down the street from me from the Board of Trade. He was swinging about listen to this number, $500 million a day in trades. That's how big a book he was managing, man. Incredible. Director of European Trading, and he also runs a fund down here for accredited investors down here in Florida. You could potentially talk to him offline about that. But last thing before I grab my glass of Pinot Noir, and I actually learn a lot from Doug each time I watch him too. He's an Army guy, so let's take it easy on Doug tonight. If you're going to ask questions like, speak in, grunts and groans, and maybe Doug will understand you, okay? So, all right, folks, without further ado, let me throw it up to our resident Army guy, Doug Robertson. Doug, I'll get out of your way. Have a good time, man, and I'll take care of questions as I can in the chat box.
Sounds good, but I do want to make a point. I'm not the guy claiming that Pinot Noir is wine. Wine is red, okay?
Good point. Good point.
So, all right. Hey, everybody. All right. Welcome to the session tonight. We got a bunch of stuff to go over. So let me give you some ground rules of what we're going to cover tonight. We are, hold on here. Let's see. Let's get the screen live. So we can actually see what's happening here. There we go. Sorry. Hey, Harry, how's it going? Okay, so this is what we're going to be covering tonight. This is a sample of the full throttle sessions. Now, I got to make a point of this. We do not have time tonight to be doing a full throttle session. When I do these, we've got 8 sessions that we do, Tuesdays, Thursday nights, and we sit down and we go through a topic in detail, front to back, top to bottom, and we don't leave until everybody understands what we're doing, how we're doing it, why it makes sense, and we know that we can do it ourselves. Tonight, I got some limitations. The fact is, I don't have as much time tonight to do this. Wiz likes to keep these focused. So what I'm going to do is a little bit different. I'm going to run through a sample of what we do in the class. And I'm also going to kind of cut it a bit short. I'm going to dive in and try to show you some practical things that you're going to learn in the vertical session that you can actually apply to your trading. So it looks like I'm broadcasting from my gym. Well, I got to keep, I got to keep moderately in shape. The trader's life is sitting in a chair. So yes, that's basically my gym behind me. How many of you, a couple questions before we get rolling here. How many of you have traded options and have traded vertical spreads, bull put spreads, bear call spreads, you name it? Okay, that's pretty common. I mean, to be honest with you, vertical spreads are meat and potatoes trades for options traders. They are great trades. They're very, very useful. They also have times when they're not so useful. And they also have times that you might want to adjust the way you're doing things to make them better, or to, try to attack things from a slightly different way. A vertical spread, bull put spreads, bear call spreads, is not one trade. It's a whole category of trades. So what I'm going to talk about tonight is a little bit of some basics. And, I also want to put this in perspective. By the time you've gotten to this class, you have been through the Greeks class, understanding how to organize and set up trades, how to define your trades. We've gone through fundamentals of the options market. We're going to fill in all the little gaps about what you need to understand and what you need to learn before you even get into the first tactic. And then this is the first of the tactics. From here, we're going to be going on to iron condors, income trades. We're going to be going on to calendar trades, both directional and volatility. We're going to be going on to events and volatility trades, portfolio management, a whole bunch of different ideas. This is a small piece of what we're dealing with. Now, it looks like, yes, recovered from Irma, doing pretty well here at this point. And if you haven't done vertical spreads, don't worry. This is something that we will teach you top to bottom. In fact, let's go into it just a little bit. So what the heck are vertical spreads? Vertical spreads, as I said before, they're kind of a meat and potatoes trade. They're something that we do a lot of in options trading because they're a good, effective trade. They are a very effective trade. How many of you have ever done buying a long call or a long put? Anybody just bought a straight long call or long put, and you're trying to do that because you believe that the market's going to go up or the market's going to go down. You've got a stock that's heading up, you've got a stock that's heading down. Okay, there's a problem with that. And a lot of new traders, there's no problem with doing this, but you got to understand that what you've done is you've just put yourself in a situation with that long put or long call where you could win, and I hope you do, but you've put yourself behind the odds. You put yourself on the wrong side of the trade. Options traders, when they're selling options, are pricing in a lot of potential movement. You're paying them for the right to use that trade while it potentially moves, and you're paying them enough so that if it moves quite a bit, they still don't lose. A long option doesn't give you the advantage that a vertical spread does. This is why, for people who are looking to do directional trades, vertical spreads are a natural next step. This is a smart move to take once you understand a little bit more about options. So what we're doing now is we're actually combining. We're taking a bull put, or we're taking a either a long put or a long call. Long call if we're a short put or a short call, and matching it up with a long option of the same type. And by combining the two, we take the major problems that you get with just buying a long call or a long put, and we make them go away. We make it a efficient trade that's got locked-in risk, controlled how it works. It's got a max profit, but that profit can be very, very good. So basically what we're doing is we're buying an option and we're selling an option and doing it together. That creates what's called a vertical spread. Basic vertical spread types that we're going to be dealing with: bear call spreads, bull put spreads. Those are your two very, very common trades that you're going to see all over the place. I'm going to show you a little bit more about those than you might see in just the basics. We also get into some of the debit spreads. Bull call spreads, that's a trade that I actually use a lot for hedging the market. We do that all the time. I've got a bull call spread right now on VXX, which is specifically designed that if the market were to come crashing down, if we were to have some form of a big correction, it's going to pay out in a big, huge way. It's going to be my bonus day. What that's going to do is it's going to offset all of the losses and all the problems I might have gotten on my other trades while the market's blowing up. So while everyone's panicking, my bull call spread that I've got on VXX makes me a bunch of money. I might take a little bit of a loss overall in my portfolio, but I walk away nice, solid, wake up afterwards, brush myself off, and have plenty of money in my pocket to trade with next. There's some great tools out there. Tonight, we're going to mainly be focusing on the vertical spreads, the credit spreads. We use them for directional trading, capturing price movements. Now, as I said before, at this point, you would have also gotten a whole session on the Greeks. You know, what's delta? What is vega? What's theta? What are all these tools that we use to understand how trades really work? So we'd be diving into using vega and theta for an advantage on these trades. But let's just focus on the basic fundamentals of the trade tonight. We'll do it, you know, go and run through a couple of these slides, dive into the market, and I'm going to show you some things that can actually be used right away if you're a vertical spread trader. Now, the nice thing about vertical spreads, I mentioned this before, controlled risks, defined max profits. Those things are both excellent tools and good for us. You know, controlled risks is something we always want to do. That's what we live for in the options market. How do we control the risk to optimize our chance to make money in our portfolio? And defined max profits makes it nice and clear what you're doing. I'm shooting for this. I'm taking this as a risk. My probabilities are X. I can make a trade. It's a smart trade. I want to make a choice that makes me money. Now, the credit spreads that we're dealing with, or I'm going to touch on tonight, out of the money credit spreads. Basics of this, we use the same expiration. Every option has a time it expires, it goes away. We're going to be using two. We're going to be buying one and selling one, combining them together. Both of those options are going to have the same expiration. We're going to be generating a net credit for the trade. Basically, we are going to be the one overall selling. We're going to receive money for this. Now, it doesn't mean it's a free trade. What it does mean is that I receive some money up front, and my goal in the trade is to hold on to as much of that money as I possibly can. The brokerage actually wants to have some money set aside for covering the risks in that trade. That's my margin. And it gives me a nice tight layout and control for the trade. Time is an advantage in this trade. Every day we hold on to this trade, we are making money, as long as the stock is basically either flat or going in the direction we want. Now, how many of you are option traders? Excuse me, how many of you are stock traders that, you know, come here and you're exploring options? Something relatively new, or you've just gotten into options and you've mostly been a directional trader. When you're trading options, we have a lot of tools to use. So Jacob, okay. And we can do trades that you just physically cannot do with stocks. There's no way to do them with stocks. So if you owned a stock and you believe that that stock was going to go up, stock XYZ, you think it's going to go up 5% over the next 3 months. If that stock, if you bought that stock long and it goes down, you've lost money. No ifs, ands, or buts. You have lost money. With vertical spreads, though, we actually have some flexibility on that. We can design a trade that not only makes money if the stock goes up, but we make money if the stock stays flat. We make money if the stock even goes against us a little bit. And we can design trades that are flat out higher probability trades with extremely good return on investments. And so that's one of the things that we're going to be doing in the session. We also want to look for a couple of structural things when we're setting up the trade. Not every tactic works in every environment. And that's one of the things you've got to understand. I see a lot of people who really know vertical spreads because they've been trading them a lot. That's what they do. What they don't realize is they're locking themselves into a specific tactic that's really good in a lot of cases, but it's not good universally. So we want to understand what's the environment that this trade works well in. What's the situation that this works well in? And what are the alternatives to using this, a different style of trade that's going to do a better job for me if I don't have what I need to make the trade work? One of the things is implied volatility. So how many options traders out there think that the implied volatility in this market is completely whacked out? VIX being just absurdly, stupidly low. All right. Absolutely, completely whacked. That's something we need to be aware of as we're doing trades, because we need to find trades that give us certain criteria, and volatility is one of those. Right now, we have a lot of situations in the market where I've got extremely clear bullish situations, but they're not appropriate for vertical spreads. And that's why I have other tactics classes where we teach other style of trades. In fact, calendar trades work out amazingly well in those situations. So that's some of the features that we're diving into here. What I'm going to do at this point, in the class, we would go through step-by-step different scenarios, different setups, different configurations for bear calls, for bull puts, for all of those different things. But in an interest to keep this moving along and keeping it interesting, I'm going to jump right into the trading platform. And we actually have all kinds of information here. When we're doing the class, you get all the slides. We cover the slides. We also do a lot of hands-on work, and you have copies of all the slides plus recordings of every session we do. Tonight, let's actually do some hands-on stuff and start playing around with some trades. Does it matter what we think? Hell no, it doesn't matter what we think. The market does what it's going to do, Richard. But we have to be aware that the way the market works means that we could be taking either a greater risk or a smaller risk, depending on what the trade is. Actually, one of the things that a lot of people don't know when they're starting out options trading is that a vertical spread on a symbol that looks, has a pattern or whatever, may look exactly the same as another one, may not be the same risk trade. A vertical spread taken on a stock that's got an extremely low implied volatility actually may be a higher risk trade for you as the options trader than something with a moderate level of implied volatility. And what you want to be able to do, every single trade that you take, you want to be able to figure out, is the trade that I'm taking paying me enough to take the risk that's actually in the trade? That's one of the things you fundamentally want to ask yourself every single time. And volatility can drive that a lot. High volatility, mid-level of volatility means that you're being paid quite well. You need to figure out, is the risk for that trade appropriate? Are you being paid well for that risk versus are you being paid a very low amount, which could be coming from low implied volatility, and you're still taking the same risk, but you're not being paid enough. So that's what we want to sort out on that. That takes some time. We need to do some work on that. But let's dive into this. I want to hit a subject that I find a lot of people could actually use some help on. Let's see. Well, I share my VXX trade? Not tonight. You can come tomorrow morning, and if we have time, I'll poke around with the VXX hedge trade during my ALTB class tomorrow. But tonight we're staying focused on the vertical spreads. Now, for those of you who are vertical spread traders, bull puts, bear calls, what's your normal time frame? And Paul, does it make sense to the current IV of the option compared to the historical volatility of the stock? Absolutely. In fact, during our iron condors class, we get into that a lot, because that can be, it's not as big a deal on vertical spreads because you are using the direction of the trade. But on iron condors especially, that becomes a major factor, and you want to understand the relationship between these two. I mean, how fast is the stock moving around versus how much are you being paid to take the risk on that trade? That's a big factor in there. And we dive into that in depth in the iron condors class. Now, the question I was asking before, what I want to dive into right now is, if you are about to take a vertical spread, bull put, bear call, whatever, what's the time frame you usually use? 1 month, okay? 1 month, 1 to 2 weeks, 2 to 4 weeks. What else? 45 days, 7 days, 7 to 10 days, 1 to 2 weeks. See, I always find this interesting because we end up getting a lot of different answers, and everybody has almost religious reasons for it. They believe that, you know, they like the shorter trades, they like the longer trades, they like all these different things. So for the people doing the short trades, 7, 10 days, maybe 2 weeks or so, why do you do a short trade? The short time frame. And by the way, there's no wrong answer here. There's good reasons to do both. But for the people doing the short one, why do you do that? Time decay in your favor, okay, this is reasonable, that's a good reason. Credit spreads as short as possible, debit spreads long enough to make 30%. Okay, Richard, we're gonna have some talks here. Okay, time decay and less movement. Now, there we go, there's an interesting one, Bob. Time decay and less movement. I'm gonna just say respectfully, you need to be careful about that thought because that's not necessarily true. All right. Let's dive into some of the aspects of risk and controlling your trade on a vertical spread. So I've got NVDA here, and NVIDIA is strong bullish at this point. Let's take a look at these trades and actually poke around with them and see if we can learn something about time, length of the trade, and different strategies for potentially managing that trade, which may get you what you want and not expose you to some risks that you might have. So, first of all, taking a look at building out a vertical spread. This is bullish right now. I am treating this as if it was bullish. Every single trade we come into, we have a commit criteria. What is the fundamental thing that we're trading in this situation? Now, without getting into a whole bunch of different excuses, why, whatever, I believe that NVIDIA is bullish. I believe it's going to stay bullish in the near future. I think that it's got some more room to move, and its recent history and recent trends have been very, very strong, bullish. I think statistically I've got a better chance of it going up than I do of it going down. So that's my fundamental rationale for the trade. Now, I've got a lot of evidence out there to support that. I've got a lot of things I can point to and say, this is one of the reasons why, this is another reason why. But I want to be clear about what I'm doing. Because while I'm in the trade, one of the things I have to do is manage that trade. And if I don't know why I did the trade, I can't manage it. So, assuming that we all agree that NVIDIA is bullish, and you may or may not, it's all right. For this exercise, we're going at it from a bullish direction. I'm going to take this with a very, very short-term trade. Now, let's see here. When I'm setting up my trades, the way I teach doing this is using a delta method to pick out your strikes. There's a bunch of different approaches, but in my mind, delta method works really well for what we're doing here. Delta is the Greek that says if the stock moves $1, the price of this option is going to change by X number of cents. So if I have a delta of 15 cents, that means that if the option goes up by, or the stock goes up by $1, that option is going to increase in value by 15 cents. Now, there's an interesting thing about delta. Delta is also a measurement of risk and a measurement of probability that the stock is going to be past that strike in the money for the seller of the option when that option expires. So another way to look at delta is that if I use a delta of 20, I have a 20% chance, based on the market pricing of the options, that the stock is going to be past that strike at the expiration of my trade. Now, the trade I'm setting up right now is a bullish trade, and I don't want the stock to go high this. I'm going to be selling, in this case, a 172.50. It's a little bit high. I'm usually shooting for about a 20 delta. 172.50 put. And buying a 170 long put. I've received a credit. I spent some of that credit to protect myself, create a limited risk trade. I've radically reduced the overall risk in the trade, and I actually reduced the margin on the trade, the cost of the trade, making it a higher return on investment style of a trade. So I went in and I created a 170 by 172.50 bull put spread. So let's poke around with this thing a little bit. Elizabeth, NVIDIA is down 660 in after-hours trading. Okay, right now that has little bearing on what we're doing. Let's just assume, you know, I'm giving you the setup and I'm walking through the trade right now. Remember, every single trade that we think about, plan out, and and do doesn't survive contact with the market. It's why I do trades live in class. If I don't do a trade live in class, if I just kind of make something up, the world could change between now and when the market opens. So for right now, follow along with the concepts, and tomorrow morning in my ALTB, we'll revise this and we'll reassess the situation on this, look at the live data in the market at that moment, and make a choice as to whether or not it makes sense. You don't, believe me, I've been dealing with this enough to know that the best plans you can make in the world do not necessarily look the same tomorrow. So we're going to take a look at that then. But for right now, I'm setting up a 172.50 by 170 bull put spread. I'm receiving a 47-cent credit on the trade, and let's go through some of the numbers in this thing. First of all, what's this thing going to cost us? Okay, James. Okay, what? Yes, it's a 47-cent credit. All right, let's walk through how this trade works. We just sold a 172.50 put. We received a bunch of money for that. We received somewhere between 44 and 55 cents, just about the middle. It's going to be about 49.5 cents roughly in credit. Now, we took some of that money and we turned around and we spent it. We spent it to basically protect ourselves. Now, if I were to just do this as a vertical spread, excuse me, as a short call or short put, excuse me, wow, I would have to pay a margin on this, which is outrageous. A percentage of the price of the stock, it becomes very, very expensive. But if I protect myself and I limit the range over which the trade can fail, then what happens is I end up walking away with a lower cost to the trade and a higher return. Now, the margin is driven by what is the difference between the strikes I'm using, 172.50, 170. All right, so we have $2.50 between those. I just received a 47-cent credit, which actually looks a little high based on the numbers here. I'm going with it, but I want to double check that. So 47-cent credit, $2.50 in the distance between the two strikes minus my 47 cents I just got paid to take this risk means that the risk that's not covered by that credit is $2.03. That right there is my margin. So if I am making 47 cents and it's going to cost me $2.03, I'm going to make a 23% return on this trade over, let me see here, 9 days. That is pretty amazing. I like that. That's a great trade, especially for a trade that, based on the delta, has about a 76% chance of winning. Of, in fact, not just winning, making a full profit on the trade. So based on the pricing of the options, I have a 76% chance that NVIDIA is going to expire or is going to be above 172.50 on September 29th, which is 9 days from now. That's great. I mean, really good trade, really good opportunity there. But I want to think about this a little bit more. First of all, every trade I take, I want to figure out what am I getting for it? How well am I being paid for this trade? So if I'm taking this trade, yeah, Chris, I think some of the numbers are coming through a little funky right now. I'm not sure whether it's in the table over here or whether it's down here. I'm going to go with the numbers I'm getting. So understand that it's after hours and sometimes the quotes are not coming through perfectly fine. Even if I were to get less on this, the concepts still work out about the same. Okay. Here, I'll try to set this up again. That is this is not me. This is Thinkorswim, okay? All right, I'll tell you what. We are going to be doing a bunch of live trades tomorrow, which will have the trade prices and everything right in them. Follow along the concepts, all right? Because I'm not trying to tell you how to do this NVIDIA trade tonight. I'm trying to teach you how to assess and understand how to make a good trade. So we'll take the numbers one by one. Let's not get too hung up on the quotes that I'm getting here, because that definitely, I agree, actually looks a little weird. And it's probably not quite right, so we'll work with that. Fact here, I'll do this. 7 cents, 3.5, 34, 47. Okay. All right. Well, I'm just gonna work with what I've got for quotes, and we'll go from there at this point. It does look a little odd to me though. Okay. So we have a trade. It's an aggressive trade. It's a short-term trade. It's only going to last for 9 more days. If I can make it past September 29th with the price of NVIDIA above 172.50, I'm going to be doing quite well. I'm going to make some good money on this trade. I'm going to have a very high return on investment. It's probably not going to be as high as this shows, but I am going to have a very, very good return. Now, one of the things I always do on this, okay, everybody, across the board, I don't want to hear this anymore. I'm going to cut the topic off right now because I'm getting all kinds of things about this. Thinkorswim seems to be giving me odd quotes. Sorry about that. It's not a whole lot I can do to fix it. That doesn't change the point. I want to show you the concepts of what we're going to be dealing with. So follow along on the concepts. Don't get hung up too much on the exact price. Tomorrow morning, we are going to be going through a bunch of trades live, and I'm going to be executing them, and you'll see the prices live with up-to-date, fresh, accurate quotes at that moment in time. So best thing to do is come tomorrow morning too. But if you want to learn something about the vertical spread, let's move on. 9 a.m. Eastern time, and we'll be going for probably a couple hours. So what I want to point out though, one of the biggest things I want to point out, and hey, Graham, haven't seen you around for a little while. Good to see you. Graham comes in from Australia. Great to see you out there. What I want to point out is how close of a price we have to the current price of the stock, 172.50. Now, a lot of people who do vertical spreads think that short time frames are safe, that a trade that doesn't last very long is Thank you, Graham. I appreciate that. Graham's been with us for a long time. He's I've actually met with him several times when he's flown into Florida. Great guy. Him and his family from Australia, world traveler and great trader. So good to see you here again. This trade that we're putting on has strikes that are very, very close to the current price of the stock in the market, 185.84. Now, if I take a look at what's happening after market, it sounds like that's gone down quite a bit, and that might also be what's affecting some of these prices in this trade. I'm not sure exactly. So, but the point I'm going to make here is that there's a misconception about short-term vertical spreads that I want to break right now. If you look at a short-term vertical spread, it is very often very, very sensitive to quick movements in the market against you. It does not mean that just because we're only in this trade for 9 days that we are out of the woods. We do get paid very well for a short-term vertical spread. The return on investment on a short-term vertical spread is really good, especially if you count the number of days that you're in. We're in this for 9 days. Let's assume that instead of 20% return, it's something more realistic like a 12% return. We're making about 1.3% per day. That is an amazing return on investment for a trade. But I'm also getting paid that because I'm taking a lot of risks. The risk is that the market pulls back and goes under my 172.50 strike in a quick, sharp movement. And it doesn't take long for that to happen. The shorter the time frame that we're taking the trade, typically the closer we are to the current price of the stocks, and the more sensitive the trade is overall to quick movements and sharp risks. So that right there ends up being a very dangerous thing. You don't want to necessarily say I'm never taking a short-term bull put spread, because that's not the right answer either. There are great times to take short-term bull put spreads. You want to know what you're getting when you're taking a short-term bull put spread. You want to know how you're managing the risks, and you also want to know whether or not you are sensitive to certain problems or certain risks. This trade right here, 9 days, if we were to have some kind of twitch in the market, I don't know, let's see what kind of crazy thing could have happened out there. A short little nut job from Southeast Asia launches a missile and it hits Japan. Maybe the same little short nut job decides to test another nuke, and it happens to be a really significantly bigger one this time. Actually, tell you what, just insert your nut job from around the world someplace and messes things up and causes the market to freak out and twitch and drop rapidly over a day or two. Think about the market saying to itself, wow, we are really high priced. Maybe I'm going to sell something. And the market just does a quick little drop. It is not unheard of. In fact, it can happen any day. What you don't want to do is you don't want to have a trade that's sensitive enough that it's going to blow up in your face when and if that happens. So let's take the next step here and look at a little bit of different, or any nut job, Stephen. The list of nut jobs that could potentially do anything like that is longer than I could fit on one page. So we've got plenty of opportunities for bad things to happen. What we want to do is we want to have smart trades that we know how to manage and we can control better. And we want to know what we're trading off when we're doing that. So AMD rattled after hours on a report that it's working with Tesla on a custom AI chip, which could hurt NVIDIA. There you go. That's not even a nut job. That right there is a reason why the market could pull back quick. And it looks like it has. Let's evaluate this in terms of risks that we're taking and maybe make a little bit of a different trade that lets us adjust the way we're doing those risks, but still gives us a chance to make the money. Now, a couple of things about short-term vertical spreads. You pretty much have to leave them on until they expire. That's just the way it's going to work. And if you don't do that, you're chewing up too much of your profits and commissions. It's very, very hard to jump out of a short-term vertical spread easy, cheaply, without losing too much of your profit. So really short-term vertical spreads, we're pretty much going to be stuck going after, waiting till expiration, and our goal is to have it above the short strike at the expiration. Now, let's start twisting this around a little bit. If we go out some, let's take October 27th. And I'm going to look for roughly a 20 strike, a 20 delta strike. I'm doing the same thing. In fact, I'm setting myself up with some very, very similar principles in the trade. And in this case, I'm going to take 21 delta, which is a 127 or 165 strike, and same $2.50 spread with a 162.50, 165, 162.50. So between those two, I get what looks like a quite reasonable 49-cent credit-ish. I think that might be a little weird too, but the point I want to show you, though, is the strike I'm taking. This 165 strike is $7.50 below the 172.50 that I was taking on that short-term trade. That's $7.50 more that the market could go against me before my trade really starts failing fast and starts going badly against me. So taking a look at this, I'm going to just put a couple of lines in here.
Hey, Doug, real quick, can you,
yeah.
I was trying to take a screenshot, but if I'm not the presenter, I can't. Do me a favor and just read Larry's comment just right there.
Everyone should be happy that we're dealing with a real platform with real data, even if the data is not 100%, not just a static slide. Many other people teach only from slides. Everyone should appreciate this. I know I do. We're in ground school. Thank you, Larry. Yes. You know,
That's a good one.
it is. I appreciate that too, because you know it is a little stressful when I've got the. It's not the easiest thing in the world when the platform's not particularly doing what I'm supposed to be doing, and I'm trying to teach concepts, but everybody's worried about the little digits on the platform. Tomorrow, I'll tell you what, we are going to be live in the market. We are going to be playing with real trades. We are going to be working through these things as numbers are going by, and we will be getting, you know, everything happening live in front of you. Focus on the numbers then, and focus on the concept and the understanding and the information tonight. Because I don't want to be the one sitting here telling you how to, you know, what trade to take every day. You are going to go nuts. I'm going to go nuts, and you're not going to get any better. What I want to do is I want to teach you how to make smart decisions and understand how to control your trades to take advantage of the situation so that you know how to make the decisions yourself. If you can't do that, you're not getting to where I want you to be. So thank you, Larry. Appreciate it. Now, first of all, I wanted to just put a couple of lines in here. I'll go back to the trade, the second trade I'm taking, and I'll show you why it's a little different and how we can play it a little different. But the first trade, my short strike was a 172.50 bull call spread, or bull put spread, excuse me, which means that if I go below 172.50 at the expiration, I am basically losing money. And as NVIDIA drops below this, I'm going to rapidly be losing money. The distance I have between the current price of the stock, which happens to be down here right now, and this line is my safety zone. How far away could, you know, how far away is this going to have to move before I start really feeling the pain? Now, I'm going to feel a little pain as it gets closer, but as long as I'm above this line at the expiration of this trade, this bull put spread, I would have been fine. But still, how possible is it that we could have a quick swing and have this thing go down right through this line? This is the line on the short-term trade. The second trade I'm taking is a little further out in time. We're taking the same delta, we're taking the same effective overall risk, but we're spreading that risk out over time, and it makes it a little bit more controllable. And it makes it so that we're not susceptible to the specific risk of the market kind of blowing up on us and doing a quick little move. So if I had a trade that was based off of a nice bullish trend, and I think overall on average that this stock is going to be going up. There's a lot of reasons why NVIDIA is a good company. They've got great chipset. They're, you know, becoming a major component of the whole AI growth boom. That's going to be a major thing. They use these chips in video cards. They use them in tons and tons of different stuff. It's a great company. It's got a lot of growth potential, and it is extremely well positioned right now. Does it have competitors? Does it have, you know, things that can hurt it? Of course, every single company does. But over time, I think that this is going to continue to move up, and it's been proving that it is a really strong growth symbol for a long time. But I care about the length of my trade. So if this thing were to pop back, would I rather have a strike that's up at 172.50, or would I rather have a strike at 165? Remember, as we approach these lines in the two different trades, that's where the trade is going to be starting to be very painful. I would rather have the extra space, because that extra space means that the stock has to move more. It has more time for me to manage the trade if it's going bad. Gives me more opportunity to understand things. And by the way, it also means that if we have something like a weird flicker, like Wiz was talking about with Apple, we don't have to worry about it as much, because that flicker happens in the wider area that we've got, and we can manage it. We don't have to get as, you know, panicked about things. We can take a little bit longer term trade. Now, as we do this, what becomes interesting is we can actually change the strategy around some. Just because we're using expirations, and in this case, we were holding on, the expirations we're using were the 27th of October. So we went from a 9-day trade to 30 days. That does not mean we have to hold on to this trade for 30 days. That's the big misconception that I think a lot of people get. I can actually set a profit target on this trade, and every penny that NVIDIA moves up, we're getting closer and closer to that profit target. We're not trying to turn this into a time erosion trade where we're waiting for time to pass. We're doing this as a price movement trade. And as the stock goes up, we get closer and closer to the profit target. In this case, maybe I would put a 10-cent limit order out to buy this thing back when this value hits 10 cents, locking in 40 cents of profit. And I could get to that point well before 30 days, as long as the stock continues to move in the direction that I want. If it doesn't move in the direction I want or expect, or it flattens out, I still win. I just hold on till the end, and I get the full 49 cents, or potentially close it out near the end for that 10 cents, and I've still made my money. If it pulls back, I've got more room for this thing to fail and go against me, letting me be a little bit more wrong. You know what's beautiful about these trades is I don't have to be right to make my money. In fact, I'm giving myself room to be more wrong just in case the world does something strange, which, as we all know, is very, very possible. We want to give ourselves the ability to control risks and control the way the life of the trade works. We can even take this out to an extreme. We could actually go and do, let me see here, and another one. I could actually go all the way out to December. Now, I probably wouldn't recommend this because you are going to be taking this trade over an earnings announcement. But what we've got here is the ability to go very far out, set up a trade, which is going to net us a very large credit. Now, this is a wider spread, so the credits aren't one-to-one here, but it's netting us a very large credit and gives us tons of flexibility on basically making our money and making our profit. I could set a profit target of about 25 cents on this, and if I hit it, I've made 90 cents on a $5 spread. Let me just run through some numbers. $5 minus $1.16, $3.84. If I hit my 25-cent limit order to exit this trade, it means that I'm basically walking away with 90 cents in my pocket. That's a 23% return. What would it take to get that? Not as much price movement as you might think. Right now, let me see, just a really quick number here. 155 by 150. Okay, making about 4 cents per. 40. NVIDIA goes up about 20 bucks, and we have a pretty decent chance of locking that trade in with roughly a 90-cent profit on the trade, which is a 23% return. So, taking a look at the charts, I don't have to hold this to December. What would it take? I'm at 185. 20 bucks is 205. Let's see if we can give it a little bit of breathing room there and say that we want to hit 210. Do we think that we could possibly hit somewhere around 210 in the next month and a half? We just made 23% return early on the trade while taking a risk where the strike is all the way down at 155. Giving us a ton of room for this thing to wiggle around and pull back against us. Still making some really, really good return on investment on a daily basis. Remember, what we really want to know is our trade working for us every day in a good way? How much money is the money that I'm using in the market making me in my trade? How much is it generating for profits? How well is it working for me? And I can make a longer term trade like that work very, very well, just putting in a profit target and allowing myself to hit it as the stock goes up. If the stock does what we believe it's going to do, we're going to hit it. If the stock is going to continue trending up, we're going to be in great shape on that. If it doesn't and it starts to fail, we're going to be able to see that it's failing well before it ever gets to that 155 strike where we're really feeling the pain and have to get out. And that gives us a lot of control and a lot of management in this trade. Gives us the ability to do things in a way that's a lot safer, a lot easier, and how I can go out and play a game of golf and not worry about the trade blowing up on me because I got plenty of room for the trade to work. Yes, Shari. We will take a look at that tomorrow. I've addressed that half a dozen times. So I can show you this clearly with the live data tomorrow though. Okay. How do I get to the 210 price again? Well, this is where we've got to do some learning. Everybody understand the concept of delta? The fact that for every $1 price or $1 that the stock moves, the options are going to change in price by X number of cents. So Paul, what I did there, and I did this quick because you guys haven't been through the whole the whole Greeks course. Some of you probably understand this, but it's really hard to teach that part without a good basis in what you're dealing with. But I can use that. I can take a look at my trade. I can look at the 15 December expiration, and I know that I'm doing the 155 by 150. I've got a 21 delta on one side. I have 17 delta on the other side. Now, if I did this, extended this out, I also know that I'll probably get an extra half a cent in there. I'm making about 4.5 cents for every $1. Between those two, I'm making about 4.5 cents for every $1 that the stock price goes up. Now, I know that I need to make about 90 cents. Now, okay, this just comes from experience and understanding how it all goes. It's not going to be quite that much every single time as we get further into the trade. It's going to taper off a bit. But I'm also going to get things like theta erosion that's going to help me out every day. I'm probably making about 0.5 cent in theta erosion each day, adding on to that. And if volatility drops a little bit, I'll get a little bonus from that. But if I know that I'm going to make about 4.5 cents for every $1 the stock moves, I need to make about 90 cents. That means that I need to have about $20 worth of price movement. And once again, you're going to get some theta erosion that's going to help us. We're going to get some potential movement and volatility that's going to help us. But within about a $20 price movement, I should be hitting about 90 cents in profit. Hitting my profit target, I walk away from the trade. So, as just a rough idea, fleshing out the trade, I can use that, and I can say, I'm at 185 right now. If it goes up to 210, which is actually about $25, I should have hit my profit target by that point. Is that a reasonable price movement over the time frame I want? I'm just doing a quick little what if. It's a sniff test. How can I tell if this trade makes sense from kind of a more rational perspective just by quickly running through a couple of numbers? Now, that wasn't quite the point that I was going to try to get to tonight. What I wanted to really teach you tonight was that you can actually adjust the time frame of your expirations and actually change the way you manage the trade to give you a lot more control. But we've got a lot of things to show you. I got a ton of stuff to show you. By the way, tomorrow morning, I believe, knock on wood, we're going to be looking at a Netflix trade that doesn't even necessarily get driven by price movement so much. It gets driven by the fear of what's going to happen for an earnings announcement. That's going to be a fun one. We're going to have a great chance to dig into that. How many of you here, okay, so first of all, Paul, did you understand the point I was making with the deltas? How I can use the way that the price of the trade is going to change. Netflix, yes, James, Netflix tomorrow morning. We're going to do a pre-earnings trade, which is going to be pretty cool. So you understood the way that the prices are going to change are going to affect the way that the profits happen. And if we know that, we can get a rough idea. Now, tomorrow morning, we're going to be doing something that's fun. I like at least, because we've got an earnings announcement or an earnings season that's coming up in the next couple of weeks. As a matter of fact, let's see here. We have, this is my chart of upcoming earnings. And in about 27 days, we have a wave of earnings announcements coming. And this wave of earnings announcements right here is pure gold. This is striking it, striking gold out in the Old West. Every one of these coming through here, this is the count of the number of earnings announcements per day, and every one of those is full of potential for trades. And so tomorrow morning, we are going to be talking about a bunch of different ways of dealing with that. And I believe if the market doesn't do anything too weird and mess up my plan, we're going to be looking at a Netflix trade and how to use the upcoming earnings announcement to basically drive a profit. Richard, do I take the plus DI, negative DI crosses on ADX indicator? I'm going to be straight with you. I am not a technical indicator person. You see my chart as it is right here? In fact, take off. You see that chart? That is the chart I trade from. Honestly, squiggly lines are more distracting to me than just being able to look at the situation. And for all of the complexity that people want to throw at trading and make it more and more complex, and when this line crosses this line and when this line crosses this line, it really comes down to some pretty simple fundamental things that you don't need a lot of tools for. It's basically a couple of rules are very handy. A stock in motion in a certain direction tends to stay in motion. Statistically, it's more likely to do what it's been doing than do something radically different. That's probably one of your number one things, just understand that basic concept. And then beyond that, I like to play with the risks of the trade and try to get as much edge out of the options as I possibly can to get me some advantage. Now, I use a lot of different things, support and resistance and things along those lines, but mostly it's just to kind of take a look at what's happening in the overall trading, get a sense of what's going on. So, a very long answer to your question, which was, do I do this? And the answer is no. Can I display the earnings spreadsheet again? Sure. All it does is, the spreadsheet is actually not properly. Hold on. There we go. Earnings. There we are. All it does is it gives me a lineup of all of the different earnings announcements for the major companies coming up. And this is a great source of trades for me because we've got a lot of volatility and a lot of things going on. I love volatility. I love playing with it. So tell you what, let's focus on that tomorrow. Come to the class tomorrow morning. We'll dive into the Netflix trade. I'll show you exactly what I'm talking about. For right now, though, we've got a choice. We have 3 different versions of this vertical spread. I showed you some of the things where you can get a little extra safety, a little extra control, while still shooting for a shorter term, good solid profit on the vertical spread. Questions? What do you have? What is my recommended time frame? Actually, let me break it down to this. Let me give you the things that you want to think about to give yourself that answer. Number 1, is the stock consistently moving along in a nice steady way? And do you trust that it's going to stay that way? Now let's get real here. There are a lot of things in the market you do not control. I do not control. I can't be perfect and I don't have a crystal ball. So let's put a little risk in there and a little uncertainty. But the more confident you are that that stock is going to trudge along in a nice, boring, predictable manner, the more you want to do a vertical spread that's short term. They're great. They can make you good money. Now, the more unpredictable the market is, as you get up the scale of how many crazy little things are going along, how many things make you feel uncertain, and especially on the symbol you're dealing with right there, the more things that you can think of. If you made a mental checklist of what would cause that stock to pull back 3, 4, 5%, over a couple of days, if you can make a big mental list of that, the more you want to go for a longer term vertical spread. Now, this also comes down to personality. Are you an aggressive trader? Are you a day trader? Are you willing to sit on top of this trade and turn it into profits by working more? And believe me, trading is work. So if you're willing to put the work in and stand on top of the trade and put the effort in, shorter term vertical spreads are great for you. No reason why you shouldn't do them, because you're there managing the trade, you can see what's going on, and as long as you're good at making those shorter term decisions, you can use that to make you more money. On the other hand, if you want to live a life, maybe go play some golf, step away from the computer once in a while, whatever, longer term vertical spreads, great strategy, but it's choosing what is the right trade for you in the right situation. So, and by the way, if implied volatility start to get radically higher, I would also recommend going to the longer term vertical spreads, because that typically means that the market's more sensitive to quick, jerky movements. So Bob, does that answer your question? With that, okay, good. Anybody else have questions like that? That's a good question. I like getting questions like that because it's important. You know, you want to know what you're doing. We also want to have a game plan for managing this trade. So let's dive into that. I'm going to use the longer term trade, and let's dive into sizing this out and laying out a clear plan for how we're going to manage this thing. And I'm going to wrap it up, and I'm going to hand it back to Wiz, and we are going to dive into our ALTV tomorrow morning and try to look at some of these things live in the market and actually do them. And when we do that, hopefully we're going to be able to talk about some of the things we talked about tonight and show you some actual executable trades. TJ Packman, is buying plain options the best for day trading? If you are the floor broker, sure. If you're the brokerage, absolutely. If you're the trader, not so much.
Yeah, I was going to say, Doug, I saw that one. I'm like, holy loaded question, Batman.
Yeah, no. You know what? Your brokerage loves you. They love you. They should be sending you gift baskets with little fruit in it and things like that. You know, and you know, cards to get back rubs and things, because you are making them a lot of money. I'll leave it at that right there. No, the answer is I would not particularly recommend that. Super short-term trading in options is a little problematic anyhow. The costs get a little crazy. But Manny, can I explain the chart in the lower half? I will in a second. Let me finish what I'm doing now, because what I just showed you is some concepts of managing risk and picking out the right trades. That's not a trade yet. A trade is when you have a plan for managing the thing. A trade is when you know what you're going to do and how we're going to handle the whole thing. So let me go through that last little piece, wrap this thing up, put a bow on it, and then I'll answer some of the other questions. And Manny, yes, I'd be happy to tell you what's in the bottom of that chart and why it's there actually. So we have a vertical spread. In fact, let me go over the Analyze tab. That is a 155 by 150 bull put spread expiring in December. I want to figure out how to turn this into an actual trade and trade plan. A couple of things. I have a reason I'm in this trade. I'm in this trade because I believe very clearly that over the next month or so time period, NVIDIA is going up. That's the fundamental thing right there. If we do not have a reason to take a trade, we do not put our money into the market. You do not ever use money just because it seems like a cool idea. You do it because you have a reason you are going to make money in your trade. So there's your fundamental thing that's actually the #1 driver of your trades. Long and short, that's it. Beyond that, what we're doing is we're managing risks. Now, stop losses do not make you money. I don't care how many people have tried to make that mathematical proof. It's BS. Stop losses do not make you money. They prevent you from taking larger losses than you should. It creates a situation where stop losses reduce the variability of your portfolio. It does not generate more profits. What we want to do is we want to have a trade that has a smart reason that's going to make us money and give it some room to work. So we want to find a stop loss that helps us do one very specific thing, keeps us from being too stupid about stuff. And we're human beings, and we are very capable of being stupid about trades. And I will raise my hand that I can do it too. I'm not perfect. So I want to put some control on this trade. My general rule of thumb in this style of a trade in this situation is I'd put about a 40% stop loss on. So let's figure out what that would be. I have 150 by 155. That's my spread, $5. I am receiving $1.16 right up front on this trade. So that means that I have at risk $3.84. If I lose 40% of that, I am going to be losing about $1.54. Let's just round it up. So I now have a number. If I add $1.54 to the price that I received for a credit on this, if this trade hits $2.70, I have hit my stop loss. I've hit my eject point. Now, there's a lot of ways to manage that, but I would basically be putting in an alert on this situation, telling me that I'm heading in that direction. I should have been noticing this anyhow. And when I hit that, my thinking shuts off. Now, I will evaluate things in the market. If we've got a crazy situation, it's just a quick fluctuation, I don't want to knock myself out of the trade too fast. I mean, that's just a great way to make the broker money. They love it when you're in and out of trades. Tight stop losses is something that, you know, by the way, anybody who's ever heard the keep your stop losses tight and let your profits run, guess who came up with that? The broker. That's because that makes them a ton of money when people actually follow that advice. So anyhow, part of my plan is I'm going to control this. I don't want to let this trade get to a price that's above 270. So there's part number one. Part number two, I want to put in a reasonable profit target that's going to allow me to get out of this trade early. In this case, I'm going to just go for 25 cents. It's a little arbitrary, but I think it's very reasonable. We can hit it. So I'm going to do that. Part number three is I need to figure out what's the size of this trade. Now, I have a little formula that I use that works out pretty well for me, and a lot of people follow along. It's not the same formula everyone else uses. People have different opinions, but I'm running our ALTV portfolio off a hypothetical $100,000 account. And then sizing-wise, I want to be able to have a good, diverse portfolio of trades. And I found that about 2.5% of that 100,000 is a good level of risk for any one of my trades. Sizing it by the risk allows me to allocate my trades relatively equally across my portfolio. If I've got a super low risk trade that doesn't necessarily make a whole lot, but it's an easy trade, it's going to be a layup, then I can appropriately size that versus something that's an excessively risky trade. I can figure out what the risk is. In this case, my risk is $1.54. So $1.54 times 100, because these are options, means I'd be losing $154 for each one of these trades I put on if it got all the way to my stop loss. 2.5% of a $100,000 account is $2,500. So that divided by 154, I can put on 16 of these. I hate weird numbers. So just personal quirk you're going to have to live with around me. I'm going to go with 15. I have 15 contracts. I have a plan for getting out in case things go bad. I have a plan for making a profit. I have a clear-cut idea of how this is going to work, and I know why I'm in the trade. From this point forward, my number one focus is the reason for the trade still valid? If the reason for the trade is still there, if my commit criteria is still strong, I'll be holding on to this until the point where my stop loss, or I get too close to the stop loss and I have to basically stop and say, am I being insane? At that point, I need to get out. So there we go. We've got the nice plan. It's laid out. We know what we're going to do. We know how we're going to make money. We know how we're going to stop our risk. And we know the game plan for making the trade work. There's the trade. Okay, what do we got? You can set a one cancel others order on TOS. Absolutely, and I like a lot of those things, but I'm going to give you a warning that Thinkorswim has been doing a really weird stuff lately, especially if you use their stop limit orders. I've seen a lot of stop limit orders get kicked out for completely invalid prices, so be a bit careful about that. Tools and automation are wonderful things. I'm a computer programmer originally. I love them. Does not take the place of good common sense and hands-on management. You know, this is your money. Make sure you're in control. Don't necessarily trust that the tools are going to be perfect for you. Do I ever use weekly options? All the time. It depends on the right situation and the right trade. I love using weekly options. In fact, my target list is mostly made up of stocks that have weekly options, so absolutely. Let's see here. Do I use the TOS platform only for trading, and do you recommend interactive brokers? I I'm not going to necessarily get on one side or the other of any of these brokerages. I will say this. Thinkorswim has an excellent set of tools. Options House has an excellent set of tools. I don't think that Interactive Brokers has an excellent set of tools, but they have cheap rates. There's different values and different advantages for every different brokerage out there. There are good things and bad things, though. Use a broker that can get you good, clean fills, and that's going to focus you on some of the top-tier brokerages. You know, your Options House, Thinkorswims, things like that. They got more access to the market, and those fills, the quality of the fills can be huge for you. So just keep that in mind too. What are the questions? Wiz, do you have anything too? Anything that you caught while I was focusing on half dozen other things? Before we leave tonight, the things that I wanted to focus on, did you get that information? Did you understand it? Tasty Trade. I actually am very actively watching Tasty Trade. You know, Sosnov is, you know, was an innovator in the market when he created Thinkorswim. TD Ameritrade came along, bought him up. Now he's off doing Tasty Trade. I don't think they're there yet, but I am very optimistically watching them and seeing what happens. We'll see where it goes. I think they could be a great brokerage. But once again, I don't get paid by brokerages. It's not my thing. I get, you know, I'm here to teach and I'm here to trade in front of you. So I don't care what platform you use. I'll show you some cool ways to get tools, but I don't care if you trade or not. Trade on that platform or not. So vertical spreads, did you get the concept behind the expiration dates and why you can adjust your risks with those? And is that helpful to you? Because if it's not helpful to you, I just wasted my time. Why were you considering adding the lower strike price spreads on NVIDIA? William, the reason I'm doing that, a vertical spread, a bull put spread. You see, actually, let me take this. You see this chart right here? It's your P&L. This shows you what happens to the price of the trade as the stock price moves. So this is the stock price. This is the profit or the loss of your trade. As you get into the trade, here, let's take a look at this. In fact,
hey, real quick, guys, Doug will be here until midnight if I don't let him. So I'm gonna give him his famous. We'll give him an 8-minute warning, folks, and then he'll tee up a little bit about what he's gonna do tomorrow. So get your final shots across the bow, but I need to put this man to bed so he's fresh tomorrow morning. So about 8 minutes for Doug, folks.
Sounds good. I'm gonna nail this quick, and we're gonna move on then. All right. So here's your short-term trade. This is the one over 9 days. If the stock moves from here down into this area, notice how fast this thing falls off and how steep it hits and basically how much of a loss you've got there. Would you rather take that trade versus, by the way, these lines are in the same place, versus having to have the stock move from here all the way down to here and having it, you know, fail on this rate, or have a trade that's all the way down here where the stock has to move all this distance before it starts failing and actually doesn't even fail that fast. You'll notice that the intermediate P&L line is a much shallower slope. The steepness of this slope is how easily you can manage the trade. If that's a steep slope, like that, this is an absolute bear to manage. When it blows up, if it works great, that's great. I'm glad. You just made money. If it doesn't work great, holding on to your profits and preventing it from taking a bigger loss is very, very difficult in this situation. So it's not always about how much of a, you know, how can you swing for the fence and make a big, huge home run. It's about the total runs you knock in. And how much of that money, you know, how much of this money are you keeping in your pocket? You know, so it's a trade-off. Aggressive trade, which has a higher ROI, versus a little bit less aggressive trade, which is much more manageable and much more reasonable to deal with when things go bad. I'm not telling you one's right or one's wrong. That's the wrong message to get from this. The right message is you have tools that you can change the way your trade works by refocusing how you design the trade. And that's what we want to get you to, is engineering the trade to do what you want it to do. When would I use deep in the money credit spreads? I love those for my hedges that I do on VXX. You are basically looking at a situation where things have to move dramatically. Deep in the money credits. Deep in the money? I was looking at deep out of the money debit spreads. I probably don't do those very much. I really don't. Okay. All right, everybody. This is a sample tonight. Wiz is going to put that proverbial hook around me and pull me from the stage any second now. I really enjoy talking with people who trade, and I love teaching. It's fun for me. You know, instead of being locked into this little room focusing on making money all the time, I actually get to, enjoy some interaction with people out there. Hope everybody had some fun tonight. Hope you got some glimmers of some things that can help you. I want to make sure that everybody walked away tonight with something valuable in their hands. Tomorrow morning, we're going to have a chance to play with some fun trades. We've got some good market setups. As long as the world doesn't end between now and 9:30 in the morning, we should have some fun stuff to work with. Would really like to see some of you join up for the full throttle. As a matter of fact, I've seen some people here have been through the full throttle. Quick reminder, everybody, if you're a full throttle member, come on back. It's a great review. And if anybody wants to pitch in and just, say what they think, we have a good time. We learn a lot. We spend a, real good focused time on education. Love to see some of you in there. Let's see. Graham, you've been through full throttle. Who else do we have that's been through this? It's always good to see the old members back here. Not the old members, the current members for that matter. And Wiz, if you want, the stage is yours.
You got it, my friend. And that's, I didn't brief that today, folks. That's one of the added benefits of getting a full throttle slot is that every full throttle we do going forward, the rest of the time you're here at TGO, you get free access to it. We usually charge $495 just for Doug's 8 sessions. You guys get it. Like Graham, I think Fish is in here. Fish has been here for what, 3, 4, 5 years. It pays for itself to get Doug's training. Like I said, every time I listen to Doug, I take a couple notes. So everybody, let's give a virtual golf clap and a virtual, head nod to Doug there. I lost count, maybe 5 or 6 slots went during his session. So I guess some of you guys didn't trust me. Maybe you didn't trust that he was an Army guy, but Doug is he's a hell of a guy. As you can see, he cares. You'll see him tomorrow morning. We do a demo do. So he demonstrated vertical spread tonight. He's going to do at 9 a.m. in the morning. So I'm going to kick ourselves clear. Doug is great. He has a lot of knowledge of what he does. Thanks, Harry. Appreciate it. One of the best in the business. That's why, hello, folks. That's why it's called Top Gun Options. We got the best of the best here. And if you think you're good, we're going to make you better. So here you go, folks. Go.topgunoptions.com/getft. And a couple, I know the support line was ringing here. If you want to call and do it, you can obviously call and do it. But and the number's down here at the bottom of the page. So let me scroll down there and show you the phone number in case you need it. It's right here, 754-300-1084. We're at the same pace as we do. Like I said, we usually do maybe 3 or full throttle big launches a year, and we're at the same pace. We'll be done by Friday, folks. We're seeing the initial people, the initial like 10, 15 people that bought that were super motivated. Now we got folks who wanted to see the training and see Doug. So we're starting to see the next full set of those people. And then by Friday, we'll see the rest of the, hey, I had to talk to my significant other or move some money around. Sorry, I answered a couple questions that said we just can't hold slots. I mean, if somebody's ready to buy their max afterburner annual slot right now, we're going to go ahead and do that. Remember, guys, men lie, numbers don't. Doug and I got our numbers. We're up here. We show everything live. I jumped on my sword with the Apple misfire, or I didn't stress strong enough that there are times when you can fly through your just and jet criteria, and that's usually when what? Your strategic mindset and your commit criteria are still sound. Okay? So, all right, Doug, thanks again for tonight, my brother. I'll see you tomorrow morning at 0900 Eastern. Everybody else, we'll see Doug at 0900 Eastern as well for his advanced live trade brief. Go.topgunoptions.com/getft and grab your slot tonight, folks, before they're all gone by Friday. Okay? Happy hunting. Make sure you hedge. God bless. Grab some coffee, and we'll see you guys tomorrow morning.